If you're a shareholder in SingPost, you probably saw the headline this morning and felt a mix of confusion and frustration. A price hike to 52 cents per stamp. On the surface, it looks like a desperate grab for revenue in a dying trade. But if you look at the broader market, the Straits Times Index dropping 0.5% to 4,507 points paints a much scarier picture. Investors are terrified of the upcoming Federal Reserve decision, and we are seeing a mass exodus to safety. The fear gauge is ticking up, and the immediate reaction is to sell first and ask questions later. But if you strip away the knee-jerk reactions and the noisy headlines about stamp prices, the real story emerging from the Singapore market today is vastly different. The decline we are seeing isn't a crash, it is a calculated pause. While the headlines scream about inflation and rate fears, the smart money is actually quietly positioning itself into future-proof assets like green financing and regional logistics. The dip isn't a signal to run. It is a signal that the market is finally filtering out the legacy players from the future giants. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through the key movers that define today's trading session. First, let's look at the macro environment. We need to talk about the Straits Times Index, or the STI. For those of you new to the channel, the STI is the benchmark index for the Singapore stock market, tracking the performance of the top 30 companies listed on the SGX. It is essentially the heartbeat of our local economy. Today, that heartbeat skipped a beat. The index closed down 2.5% at 4,507.08 points. Now, why does this matter? You have to understand the context. The market right now is like a runner holding their breath before the starting gun. That starting gun is the US Federal Reserve's upcoming decision on interest rates. When interest rates are high, or there is uncertainty about them staying high, money becomes expensive. Companies borrow less, growth slows, and safe assets like bonds become more attractive compared to risky stocks. That is why we saw Singaporean investors taking money off the table today. Taking money off the table is a trader's term for selling a portion of your investments to realize profits and holding cash. It is a defensive move. It tells us that the general sentiment in Singapore right now is safety first. But, as we always say on this channel, volatility is the price of admission for returns. While the general market played it safe, 3 specific stories emerged that tell us exactly where the value and the danger lies. Let's move to our first major mover, SingPost, ticker symbol S08. SI. The headline news is that SingPost is increasing the price of a standard stamp by 10 cents to 52 cents, effective January 1st. The CEO came out and called this a necessary step to cover structural costs. Now let's break this down analytically. What do we mean by structural costs? In accounting and business terms, structural costs are the fixed expenses you have to pay just to keep the lights on and the trucks running, regardless of how many letters you actually deliver. Here's the problem. SingPost's domestic mail business is a legacy business. It is a business model built for a world that no longer exists. A world before email, WhatsApp, and digital billing. When you have a business with high fixed costs, postmen, sorting centers, vans, but the volume of mail is dropping every single year, your profit margins get crushed. This is what we call negative operating leverage. The only lever they have left to pull is raising prices. But here is Iggy's perspective on this. Raising stamp prices is a move from the 1990s playbook. It is a defensive, almost desperate attempt to squeeze water from a stone. If you are buying SingPost shares today because you think a 10-cent hike is going to save their bottom line, you are missing the forest for the trees. This is a classic example of a company trying to bandage a declining legacy segment. Does this make SingPost a sudden buy? Absolutely not. It is a minor fix for a major long-term challenge. However, we need to be nuanced here. SingPost is not just a postman. The real story I am watching, and the only reason you should even have this stock on your watch list, is their e-commerce logistics division. That is the part of the business that handles parcels for Alibaba, Shopee, and Amazon. That is where the future growth lies. The stamp hike is just noise. It is a distraction. If you are a serious investor, you need to ignore the 52-cent headline and look at their international expansion strategy. Are they winning contracts in Australia? Are they efficient in their logistics network? That is the thesis. For now, this news is short-term noise to cover a bleeding wound, nothing more. Next, let's pivot to something much more interesting. OCBC Bank, ticker 039, S. This is a story that got buried under the market dip, but is infinitely more important for your long-term portfolio. On Monday, OCBC's mezzanine capital unit announced a massive investment in a US $1.5 billion low-carbon steel plant in Sabah, Malaysia. Despite this forward-looking news, the stock actually fell 1% to close at 18,073. Let's unpack this. First, what is mezzanine capital? It sounds complex, but think of it as a hybrid between debt and equity. It is a layer of financing that gives the lender, in this case OCBC, the right to convert their debt to an equity interest in the company in case of default, or usually it just offers a higher return than standard senior debt. It is a higher risk, higher reward form of lending. Why is this specific deal regarding a low-carbon steel plant so significant? Steel production is traditionally one of the dirtiest, most carbon-intensive industries in the world. By financing a low-carbon plant, OCBC is not just talking about ESG, environmental, social, and governance. They are putting real money behind the green transition. From Iggy's perspective, this is exactly what I love to see. The market shrugged it off because the market is short-sighted. They are looking at the 1% drop in share price today. But as long-term Singaporean investors, we need to look at 2030. OCBC is positioning itself not just as a place to park your savings, but as a key financier of the region's industrial evolution. This builds what we call resilience in their loan book. In 10 years, carbon taxes and regulations will make dirty steel expensive and risky. By backing green steel now, OCBC is future-proofing its assets. This dip to say 1873, to me, that is a non-event. It is a buying opportunity for those who understand that banks aren't just about this quarter's net interest margin. They are about the quality of the projects they finance. Now, let's look at the final piece of the puzzle today. Mandarin Oriental, ticker MZO4. The news here is finality. Shareholders have voted to approve the takeover bid from Jardine Matheson. The acquisition is now just waiting on one final condition, the sale of a property in Hong Kong. Let's define privatization, or a takeover bid for those new to the game. This happens when a larger entity, in this case the Jardine Group, offers to buy all the outstanding shares of a company to take it off the stock market. Usually they offer a premium to the current share price to entice shareholders to sell. Here's the analysis. This saga is effectively over. The stock is now trading at or very near the offer price. This means the arbitrage gap, the difference between the market price and the buyout price, has closed. There is no more juice left in this lemon. From Iggy's perspective, if you were playing this for the takeover pop, congratulations, you won. But now the game is over. If you are still holding these shares, hoping for a higher bid or some miracle, you are making a mistake. The upside is capped. It is time to cash in your chips. Do not be the investor left holding the bag when the music stops and the stock delists. You need to take that capital and redeploy it into assets with genuine growth potential, perhaps something like the banks we just discussed. So, how do we summarize today's session? What is the assessment? Let's look at what's working. First, the fortress balance sheet strategy is working. Banks like DBS and OCBC, despite minor daily fluctuations, are making the right strategic moves for the next decade. They are capitalizing on the underinvested narrative in Asia. Second, the green transition thesis is alive and well. OCBC's move proves that the big money is flowing into sustainable infrastructure. Third, the privatization cycle is working for those who know when to exit. Mandarin Oriental is a textbook example of a special situation paying off. Now, what's not working? Legacy businesses without a pivot plan are struggling. SingPost represents this struggle perfectly. Raising prices on a dying service is not a growth strategy. It is a survival tactic. Market sentiment is also not working in our favor right now. The fear of the Fed is acting as a drag on the STI, keeping valuations artificially low. So what about valuation? The STI at 4,500 points is trading at a discount compared to global peers. As DBS investment strategists noted, Asia is underinvested. This means the price-to-earnings ratios and price-to-book ratios of our local blue chips are attractive. You are getting high-quality assets for a fair, if not cheap, price. Here is my final recommendation. For existing unit holders and shareholders, if you hold OCBC or DBS, hold tight. Do not let a 0.5% or 1% drop scare you out of a generational compounding machine. The fundamentals are stronger than the sentiment. If you hold Mandarin Oriental, sell. Take the profit. The story is done. If you hold SingPost, you need to be very honest with yourself. Are you holding for the logistics turnaround? If yes, hold and monitor. If you are holding because you think stamps are a growth business, sell. For new buyers, I would say accumulate. The risk reward for Singapore banks is excellent right now. I would be looking to dollar cost average into OCBC at these levels, specifically targeting that $18.70 range. I'm also looking closely at CapitaLand Integrated Commercial Trust. With the market nervous about rates, best-in-class REITs offering a safe yield are a great place to park cash while we wait for the Fed to clarify its stance. This is a classic paid-to-wait strategy. To wrap this up, today was a day of noise. SingPost made headlines, but OCBC made history. Don't let the price of a stamp distract you from the billion-dollar shifts in the green economy. Stick to the strategy. Continue to dollar cost average into your favorite blue chip stocks and high-quality Singapore REITs. Look for companies that are building the future, not just patching up the past. While the market holds its breath, we can be quietly building our positions in solid dividend-paying assets for the long run. If you found this analysis valuable and want to go deeper than just the headlines, consider becoming a free or paid subscriber to the Investing Iguana Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, keep your emotions in check, and I'll see you in the next analysis.